Good morning. We will pay attention to depreciation on fixed assets today. We will do two methods. The one method is the cost price method, that's also called straight line method or fixed installment method. When we use this method, we calculate depreciation on the cost price for the whole period that you use the asset. So that's why it's also called straight line, because you will write off the same amount of depreciation every year, and that's why it's also called fixed installment. According to this method, an equal amount is allocated to each accounting period over the useful life of the asset. So if we decide to use this asset for 5 years, it means that we will take the cost price divided by 5 to see how much we have to write off each year. You can also divide the 5 into 100%, and that means that you have to depreciate your asset with 20% each year. If we look at the schedule that was drawn up here, this asset was purchased on the 1st of January 2011 at a cost of $10,500. So the carrying amount, what it was worth, was $10,500. After we used the asset for a year, at the end of the financial year, 31st December 2011, we will take this $10,500 divided by 5 and record $2,100 as the expense for 2011. So the depreciation expense that will be recorded in the profit and loss account will be $2,100. And the accumulated depreciation account will be credited with $2,100. So at the end of the year, the asset is not worth $10,500 anymore. Because we depreciated it, it means that the carrying amount is what is it worth on that date is $10,500 minus $2,100. That will give you $8,400. On 31st December 2012, we wrote off depreciation again, $10,500 on the cost, and the depreciation is $2,100. Now the total depreciation from the 1st of January up to the 31st of December 2012 is $4,200. So it's $2,100 for the first year and $2,100 for the second year. The carrying amount, what is it worth after the second year, is the cost price of $10,500 minus the $4,200 accumulated depreciation. So the asset is worth $6,300 at the end of December 2012. At the end of December 2013, we will write off depreciation on the cost price again, $2,100. So our expense will be $2,100. Our total depreciation that accumulated over this 3-year period is $4,200 plus the $2,100 will give me $6,300. What is the asset worth at the end of 2,300? The cost price, $10,500, minus the accumulated depreciation of $6,300. So the carrying amount is $4,200. And we will carry on doing this for the full 5-year period. At the end of the 5-year period, we will have a carrying amount of 0, because then we've written off the total amount of depreciation. That means you can't go on writing off depreciation even if you still use the asset after the 5-year period. You can only write off depreciation until you've written off the total cost price of $10,500. If we use this asset in 2016, we will not write off depreciation because we've already written off the total amount up to the end of 2015.